So CG Group acquired the bank in November 2023. One of the statements that Mr. Dilshan Rodrigo mentioned was that he wants Union Bank to be one of the top 5 banks by 2029. 2025, we delivered a 4 billion growth in pawning and a 10 billion growth in leasing. For them, crisis is synonymous with opportunity. From the time Dr. Chowdhury invested in the company, I'm pleased to say that we have delivered 80 to 120% return, and that is 50% more than the market return. It's like a aircraft carrier and a fast attacking craft. Like the aircraft carrier is the big banks, right? They can absorb a lot of firepower. But the fast attacking craft is basically focusing on precision, maneuverability and focus. That's how they succeed. We are very, very obsessed with driving digital on the front line. So digitalization can eventually get to a stage where what used to take weeks can be done in minutes. And ultimately, when the country benefits and the business benefits, banks benefit as well.
Sri Lanka's return to economic growth is now showing in company income statements. Nowhere is this more apparent than in the financial services sector. Union Bank, one of Sri Lanka's smaller commercial banks, has shown remarkable advancement in 2025 when it grew its loan book by over 80% and profits have doubled. In the studio with us today is the CEO and Director at Union Bank, Dilshan Rodrigo. Dilshan, it's great to have you join us here at Echelon. Let's start here. Union Bank has demonstrated strong recent performance in your financial year that you just completed. Higher profits, balance sheet has grown quite aggressively and more efficient, I think, more productive as an organization. How do you plan to build on this momentum given where Sri Lanka is right now?
Once again, lovely to see you again, Shavindra. Just to say that, when we last spoke, I had just taken over as the CEO of the bank 2 years back. And so it's been 2 years. It's been 2 very exciting years. So CG Group, if you remember, acquired the bank in November 2023.
Right. This is the Nepali Chowdhury Group.
That's right. So since then, it's been a breath of fresh air. It has really awakened the bank. It's a 30-year-old bank. In the last 2 years, we grew our loan book by 80%, halved our NPA, and we doubled our profit in the last year. So I'm, proud of what we've achieved, proud of the team that made it happen. So as a bank, this is a bank with a very high operating leverage. It's a bank, where you have to sweat the existing infrastructure harder to be able to generate profits, right? Because we have a significant branch presence, technology, and over 1,000 staff, which is a huge overhead for the bank. So we have to grow the bank. That is inevitable. Growth is something that we have to do. And I'm fortunate to have a young team, top management team to the branch managers are probably a decade younger than the industry. So they are, much more driven. There's energy and they're also very receptive to change. So we've done a lot of changes to the operating model that we run, and that has really, paid dividends. So one example of that is that the steep learning curve, in 24 last quarter, we introduced pawning and leasing, right? 2 conventional products, but it was launched in Union Bank only in the last quarter.
Right.
And in the very first year, 2025, we delivered a 4 billion growth in pawning and a 10 billion growth in leasing, which is on par with, say, the top 6 banks in the country in terms of growth levels. So that's the kind of momentum, with the right kind of incentives, the right kind of focus, right kind of capacity building that is possible in this bank.
So you gave us 2 examples. That's the growth you had in credit in pawning from 0 again, from leasing from virtually 0 again, right? When you look at the opportunities as a whole, how do these figure when you're looking forward at the next 1 or 2 years? These 2 plus, where else do you think the opportunity?
So we expect the pawning business to continue the same kind of momentum. As you know, gold prices have more than doubled in the last year and a half. And with all the uncertainty that is happening all over the world now, the geopolitical issues, the wars that are unexpected wars that are taking place, gold is going to continue to be a
Safe haven.
So, of course, there is always a risk, the market risk associated with sudden gold price plunging, but that's the risk we are taking and we are managing.
What is the loan to value ratio in gold?
Usually, banks operate at about 70-75% loan to value ratio. So that's on pawning. But of course, as you know, maybe the honeymoon period for leasing has now ended because I don't know whether that same level of momentum on imports will continue because there's a lot of unsold vehicles in the market today. So I think the second-hand market is going to get very active this year, and that will market forces themselves will determine that people are not going to import as many vehicles as they did before. So leasing, but is probably still carry the same kind of growth momentum or probably a little lesser, but not with new vehicles, but with the existing vehicle stocks that are already there. So we see that continuing this year as well, and accordingly we have developed our strategies as well to focus on tailored products to support the second hand leasing market. So that's as far as those two products go. But as a niche bank, we are not a mass market bank by any stretch of imagination. So we have to pick the areas that we want to work in very carefully. Right. So that has been our focus. So gradually we'll bring in variations of products that make sense. So for example, if you take pawning, now we've introduced our gold loan with various tenors. Then you have ladies product called Power Her, which we are introducing shortly. Then we are also coming up with a pension product. We are also looking at a product with a lot of value additions or the insurance and so on. So there are certain niche areas that we focus on that we believe, it makes sense for us.
Okay. If you kind of step back, you've been on the job for 2 years now, and what strategies that you deployed at the outset, and then you joined the bank after the Nepali Chaudhary Group had taken a controlling interest in the bank. What strategies did you deploy then that you think are yielding the results? Credit growth of 80%, profits have doubled in that time, and the book and the asset base is much larger. You identified two at least, but when you step back, what are those strategies that are really working for you right now?
So I'll take a step back and say what were the three biggest problems that were confronting me at that time. The first was the staff attrition, right? So there was a feeling of sort of helplessness because the organization, it was 3 years or 4 to 5 years of inactivity before Dr. Chaudhary actually took over the bank. Before that, of course, it was TPG. But there was a period of activity where the sale was going to take place, where during that difficult period in the country, they didn't do much, lending or active marketing. So that was a concern. So there was a little bit of a issue with regard to the staff in terms of motivating them to be a part of that team going forward. So we had very high attrition. That was one big concern. Second was the legacy NPA portfolio, right? I had almost 1/5 of my book, or a little more than that, in non-performing when I took over. The third was the high operating leverage. Our cost income ratio was 82% when I took over, right? So there were, I can think of maybe 5 areas that we focused on. First was really about capacity building staff. So we had various programs from soft skills development to leadership training, PIM, negotiation skills, selling skills, then the technical programs on credit, on operations, IT, and then collaboration training, where we had a lot of teams, cross-functional teams working together to address common issues, role plays, scenarios, AI training. So there was a lot of different areas that we focused on the capacity building, and that really yielded results, because one of the things that came from that was also the confidence to multi-skill. So we created a mindset amongst people that when you are in a branch, we probably have the smallest number of staff in any branch.
Okay.
Right? But everybody has to be an all-rounder. Right. There are no specialists. So we are probably the bank that where even the pawning guy would be, who's generally a specialist person in any other bank, is actually involved in mainstream banking activities as well. Because we realize that maybe 20% of his time would be on pawning, 80% of his time he's free, he can do a lot of other things. So that was something that really helped us, and we supported that with performance-based pay to drive that culture. because our salary scales and all that, being a bank for a while that required that kind of momentum, we had to support to ensure that we are creating that discrimination. If you deliver, you'll get a better return. So that based pay, we have something like 21 incentives in the bank. And that really, focus people, created the right kind of spirit for growth. A third area is the branch model, right? We looked at the branch model critically and we said, what is the role of the branch manager? So there is something, where we work on a hub and spoke model, right? The hub is the center, the spokes are the branches.
Right.
So you have the branch manager who is the customer service, sales guy.
Right.
And then you have the deputy branch manager managing the operations, compliance, customer service, all those areas. So there's one guy doing the selling and you have a team behind him. And we minimize the number of people who are managing the operations work and maximize the amount of people who are getting involved in selling. And
Facing customers.
And
Because
then
you brought
ultimately,
you centralized decision making in a way because credit was managed centrally.
Absolutely.
Right.
So credit as well as operations,
Right.
that was an initiative that I only continued.
Right.
They had that model when I joined, but we improved it. So we took a lot more activities out of the branches to the center,
Right.
so that the branch people are relieved. Just like a showroom. If you go to a car showroom, you only see the guys who are coming and encouraging you to sell, buy the car, right? You don't see the back office. So that's the model that we are trying to drive in the branches. So that is something that we have, now it has matured and it's starting to really yield the results that we expect. Of course, there is some more that we need to do.
How did you fix the operational leverage problem you have? Your costs were too high versus your net income. How do you fix that?
Two things. One is focus on growth. Grow your sales. So if you take the last 2 years, we grew our sales grew our loan book by 80%. Balance sheet growth of 80% in the last 2 years, right? So that helps because now you have a bigger sales.
Growing the numerator
is higher. On the cost side, also look at how do you reduce costs? How do you improve efficiencies? How do you improve productivity? That's where the performance-based pay and the efficiencies start coming. So more CASA per branch, right? More deposits per branch, more anything, more pawning transactions per branch. So you drive that focus, then automatically the cost income ratio starts coming down, but it doesn't come down as fast as you like. This year we are looking to bring it down below 70 from the 82% we were 2 years ago, which I think is a great achievement. And I'm very confident we will be able to bring that down.
Right.
So there is a lot of focus in that area. And maybe the last area is the recovery model. So again, we created three verticals under recoveries. One was the big tickets. There were some big loans that were, accounting for something like 40% of the recoveries, non-performing loans, where we managed to strike deals, negotiate, and come to some arrangements in terms of how to restructure the loans and get people to start paying. So that was a success last year. Along with that, we have the SME portfolio, which has, as a lot of issues in the last 3-4 years back when the economy went into tailspin. A lot of the SMEs actually got into lots of difficulties. So we again worked a lot on reschedulements, asset sales, and managed to get a lot of leverage there. And then third was a retail portfolio, which is a legacy portfolio. Again, we hired outsourced parties and we managed to bring that also into order to some extent. That's how we have the recovery NPA portfolio. But there's still more to be done. I mean, I think by the end of this year, I'm quietly confident that we'll be on par with the industry in terms of NPA because the top line also has grown. So that helps in terms of the average coming down. So, and that makes a huge difference.
What has it meant to have shareholders like the Chaudhary Group? I mean, I think the Chaudhary Group purchased the stake that TPG, a private equity firm, held in you, 70% or so. So you have a very dominant shareholder, which is very unusual in financial services, in banking in Sri Lanka. What does it do for a bank when you have one large shareholder like that?
So they're very aggressive, right? They're not going to get into something just to be a part of something. They want to be a top player,
Correct.
right? So I remember when I took over as a CEO, one of the statements that Mr. Nirvana Chowdhury mentioned was that he wants Union Bank to be one of the top 5 banks by 2029. And it went on a newspaper. So that put a lot of pressure on us, right? How can you be a top 5 bank when you're probably the smallest bank at that time?
At the time, yes.
Right? So, but that translated was very aggressive growth organically. But even that is not adequate. So at some point, there is also inorganic.
Yes.
So that is already built into that thinking. So through organic and inorganic means we need to achieve this expectation. So that is, I think, the single most influence that came through. On top of that, of course, there are areas where there is synergy. For example, they brought in BYD through their association with John Kears. So that helped us in our leasing growth because we were the preferred bank in the BYD segment. So as you know, maybe 30-40% of the vehicle sales that took place in 2025 was the BYD segment. They were the first half of the block. So that gave us an advantage. Then we also have a program called Union Bank School of Social Entrepreneurship that we are working with Moroto University. And that was a brainchild of Nirvana Chowdhury, who has a similar program in Nabil Bank. So we do that to help nurture and develop entrepreneurs, which in turn helps us in terms of the way in which we work with societies and communities around the country.
You referred to Nabil Bank there. Just by way of context, the Chowdhury Group owns a bank in Nepal where they are from. That's where they originated, and that is Nabil Bank, right? And say when you look at what you can potentially learn from a country like Nepal, or what the Chowdhury Group has done with its Nepali-owned bank, what are those things that you think are relevant for Union Bank of Sri Lanka?
I think it's that resilience. I think countries like us are also resilient. Even Sri Lanka by its own means is resilient. But you've seen what's taking place in Nepal, even in Sri Lanka. They are able to bounce back fast. I think that's something that I remember when the whole world was, struggling with COVID. We had to struggle with 3 different things. The Easter Sunday bombing, COVID and a financial crisis. But still we've now bounced back. So that is something that is in their ethos as well. So, for them, crisis is synonymous with opportunity, right? So that mindset of always learning to bounce back, thinking positive, looking at opportunities when there is issues on the surface, that's really that entrepreneurial instinct or spirit that comes through. And that's what I'm trying to create in my staff at Union Bank as well, through the performance-based pay, bringing in performance-based incentives. That really makes a difference. Then it becomes your bank, your issue, and your earning capacity being influenced by yourself, versus an entitlement mindset versus a performance mindset. That's really the message that comes through for me.
Dilshan, Union Bank has reasonably strong capital buffers, right? And now you're positioned for kind of accelerating growth. I mean, you grew your book 80%, which by far must be the highest in the banking industry, right? How will you ensure that expansion delivers sustainable risk-adjusted returns, if at all? I mean, as CEO, you can't just look at the return, you have to...
So I must say upfront that our capital is getting exhausted now, right? Because this type of growth cannot be sustained with the capital we have. When we started off, yes, we were the most capitalized bank. But now, as we speak, there is a 3 billion debenture issue that is in the market, and that will get subscribed probably on the 10th of March, right? So that is every year or twice a year, I will need to supplement capital to sustain this level of growth, which is fine because our shareholder is very comfortable. They might come in with rights issues, or we can go with tier 2 debenture issues. All that means that we are going to be far more in the market going forward.
Oh, so what is your capital adequacy right now?
Now it's very tight, maybe 12.8, whereas we should be above 12.5. So once these funds come in a week's time, we'll probably be around 13.5.
And this is tier 2 money, or
this is tier 2? Tier 2. So the important point here is that when you're growing aggressively, you have to continue to supplement capital. And so obviously in this stage of my growth, it's more about equity-based returns. So if you take our share price from the time Dr. Chowdhury invested in the company, I'm pleased to say that we have delivered 80 to 120% return. And that is 50% more than the market return.
Wow.
Right? So the potential for growth on the share price is far, far more, given the kind of momentum that we are starting to create with this bank.
And as you deploy this money, you have to look at not just absolute returns, but risk-adjusted returns. In some areas there's higher risk, but when you have to also consider the adjustment, right? So when you take that equation into account, risk-adjusted returns, what do you think are going to be your priority areas for credit growth from where you are now? Because capital is getting tighter now.
Yeah. No, you're absolutely right. The first year was about balance sheet growth, right? It's about saying, look, here, we are there. We can support you. And then getting our, leg inside the door. But now it's really about, ensuring that we get the right kind of risk-adjusted return in the right segments that we operate in. So we pick our segments very, very carefully. Those areas that we see have the biggest returns for the amount of investment that we are putting in. So we look at higher yielding, faster churning, less variable areas to focus on. So that's where areas like supply chain financing for our SMEs, leasing, pawning, where there are secured retail loans, then top local corporates in the corporate banking segment, trade, cash management. Those are the key areas. So within those areas, we have tailored products which really suit the requirements of our discerning customers.
And you're talking about fund-related growth, right? Not fee-related growth here.
Fees as well. So trade would come, in terms of guarantees, in terms of bonds. So all that, is a potpourri of returns that you can make.
So when you look at a balance sheet of the size of Union banks, you are not the largest bank. You are, in fact, one of the smallest commercial banks, licensed commercial banks in Sri Lanka. How do you plan to make, if you said, create an opportunity in every crisis, right? Now, if you have a challenge, is the size of your balance sheet, but how do you make that an opportunity? How do you make it work for you versus be an impediment?
So if I take a analogy, what you can relate to now with what's going on, it's like a aircraft carrier and a fast attacking craft. Right? The aircraft carrier is the big banks, right? They can absorb a lot of firepower. But the fast attacking craft is basically focusing on precision, maneuverability, and focus. That's how they succeed. So that's what it is about. Going forward, now I go to a lot of banking conferences, they project the buildings of a bank. It's not about that anymore. It's about agility. And that agility comes from digital. So we are very, very obsessed with driving digital on the front line, which is in terms of our mobile banking app as well as our SME or the corporate banking app. And outside that, the back office digitization. So there's a lot of work that needs to get done to really be able to offer a service to a customer, making banking simpler, even enjoyable. Because you should be able to do something which you used to do before, which took you days in minutes. And I'm sure your experience that gig already with on the mobile, but that's just a start. There's a lot more that's happening. So you can open an account now without having to visit a branch. You have non-face-to-face account opening. You can apply for a loan on the phone, right? In a matter of minutes. I'm not saying that we fine-tuned all these things to perfection, but that's the journey for us. And you can use AI, right? There's so much potential for AI on a lot of our activities that we do in the bank, where it streamlines the process, improves the productivity, efficiencies, a lot of duplication is taken out, and that ultimately translates to that experience that the customer enjoys with the bank. So digitalization and digitization, right? Both the front as well as the back office is a key imperative. So that's where the transformation is.
How do you measure success? I mean, I think you kicked off this process. You joined the bank at the same time the Chaudhary Group became its major shareholder. And I recall a conversation where Nirwan Chaudhary was talking about how passionate he was about creating a newer bank, a kind of digital bank, right? But how do you measure success? I'm sure you kind of made some investments in that time. What is the measure of success on digitization?
So there are various indicators. For me, it's a very simple thing, right? What percentage of your banking transactions are done digitally?
Correct.
Right. So that's something we track. So, if you go to a branch, you don't have to go to the counter anymore. You can go to the cash recycler machine and deposit cash, notes, right? You can withdraw funds on the ATM or from the cash recycler machine. You can do a lot of your day-to-day transactions now on your mobile app. So we track that and we work out what percentage of the transactions are done manually, what percentage is done through the system for the bank. And that ratio would dictate where you are on that journey. So for Union Bank, we moved from 64% to 75% in the last year. Still a long way to go, right? So some of the more progressive banks are probably close to 90%, right? But that's a journey. That's a very important indicator of the progress. That's one. Second thing is the turnaround times. How long does it take for you to get a loan approved? Is it weeks? Is it days? Is it hours? Or is it minutes? So digitalization can eventually get to a stage where what used to take weeks can be done in minutes. So that's another important area. Then the customer perception scores, right? So you go on to any, Apple or Android, you see the scoring that is given by customers, the rankings. So that's another important area. Then on the back office, the biggest waste in a bank is not getting things right first time. The rework ratio. So that's another very important thing that we follow.
In all my conversations with you, this has come out. You've been very passionate
That's the biggest area.
Eliminating
so getting
the
things
rework.
right first time. And of course, driving the paperless culture, checkless culture, cashless culture. So you have to track all that. I track the paper consumption by department, by branch, and then I see how much they have progressed and how they have actually moved things from paper to the system. So it's simple things like that. Then that's how you drive. Because by doing that, you're changing the way you work, right? So previously, when we started banking, there was something called the voucher bundle, where you used to count the voucher bundles, you used to bundle it. Now that is going to go away because all the transactions happen digitally. You don't need voucher bundles anymore, right? So even the few that you have, is there a different way of doing it? Is there scanning that can be done instead of actually storing it and then send it across to the head office for warehousing? So it's about really looking at the way you run the organization and really embrace it. If you don't, you will find digital banks coming and eating your meal. And you already seen Google Pay, Apple Pay starting to knock on the door and come to the country. So once they do come in, the entire payment space is going to get transformed. So if you are not adept at this, then somebody else is going to take your piece of market share.
So we were discussing challenges around capital. I mean, you have a fast-growing portfolio, which means you're using up more capital to back it. You also need to manage. You need to keep shareholders satisfied, which means you have to make sure you have a decent dividend policy that you can stick to. Of course, a dividend policy in the long term erodes your ability to grow because you're distributing what you otherwise can reinvest in the business. As a CEO of a bank the size you are, with the challenges that you face, how do you navigate these strategies around this?
So it's a growing bank. So at the moment, all the earnings we make have to get reinvested with business because we have legacy technology that has to get upgraded. There is a lot of investments that we need to support the growth that we are going through. So that value to the shareholder comes from the share price appreciation. That's where the return
comes from.
At least maybe for the next 3 to 4 years. So even when we do issue a dividend, it will be an equity dividend. not a cash dividend. So that's the focus. So as I said earlier, we have got a big a big increase in the share price in the last 2 years, which is above market returns. So I think that gives the comfort to the shareholder that the money that they spend is well spent. But the future, this kind of growth momentum that we are creating, when the critical mass starts to build up, the incremental returns become much, much higher. Because at the moment, when I joined, we are paying tax of over 80% of our profit, right? So that is a correlation between tax and cost income ratio. Higher the cost income ratio, higher the tax. So as you continue to bring your cost income ratio down, you lower your tax. And then there is a quantum increase in your profitability, right? So it can almost, increase by 50, 60% year on year because of that impact as the operating leverage impact comes down. So that's the benefit that comes through in a smaller bank. So for me, having worked in a bigger bank and moving into a smaller bank, I understand the dynamics very differently. So there's a lot of work that you have to do in terms of making sure that you're focusing on the granular things. Get everybody focused on their P&L at a branch level, at a segment level, at a business level, and everybody at a product level also to understand their P&L and really work towards the right kind of factors or the ingredients that will really make a difference to the number.
Sure. Say, as CEO, you have to watch every line of your balance sheet. On the asset side, you have to watch the quality of your book. On the liabilities side, you have shareholders to manage. You have expectations of everybody who's funded it, including your depositors. You also have the regulatory setup. You have to make sure you're compliant ahead on things like capital. You have to make sure the buffers are available for you to utilize the runway that you're creating. From where you are, where do you think the bigger challenges are for you? What are those few kind of milestones that you have to hit, the kind of things you have to overcome, 1, 2, or 3 things that you have to overcome in these areas I'm talking about? Maybe there are others that you'd like to add too.
So just to take on board what you just said, right? The better the brakes in a car, the faster you can drive, right? So you cannot for a moment, compromise on risk management, compliance, audit, right? These are critical areas. Even technology, right? The future of banking is in technology. So that's an area you have to invest in. In the future, we will not be investing in any buildings, right? Technology investments outpace any investment in infrastructure by tenfold. But you have to make those investments. Without having the right kind of technology infrastructure, you cannot go digital. You need new APIs. You need to overhaul your core banking system. You need to overhaul some of your product systems. So without that, it's extremely difficult. So that's another important area. And maybe those are some of the key areas, but people, so like I said earlier, multi-skilling them, getting the best out of them in terms of mentoring, coaching, succession planning, showing them that there is a career in the organization if you're patient enough, where your career is well taken care of, that roadmap for them. That part matters a lot. Performance-based pay is a start, but along with that, there has to be a charter for them to think, look, this is the journey for me. And in a smaller bank, you have the opportunity to grow much, much faster than a bigger bank. The bureaucracy is far less, much less levels. So if you are good, you could move up 2, 3 notches much faster than in a bigger bank. So that's a big motivation for our staff, right?
This is the battleship versus the aircraft carrier analogy, right? In terms of growth, you also kind of ventured to say that, hey, inorganic growth, which is, growing by acquisition or amalgamation, has to be something that I think Union Bank would want to consider. What's the rationale? I mean, we've not seen bank consolidations in this country ever, I think, right?
So the regulator is now encouraging this because they have said if you have an asset base of less than 400 billion, right, by the end of 2027, then you need to be looking at consolidation without any doubt, right? So for a bank of our size to get to 400 billion in 2 years is near impossible, right? So for us, it is inevitable that we need to look at a partner and then see how that is going to, support the journey that we have. So I think it's fair to say that we have too many financial institutions, banks and NBFIs in this country. We have over 100, right? So there is definitely an opportunity for consolidation and then benefit from the economies of scale. So I think that journey is inevitable. And what we can bring to the table is that dynamism, the agility, the model, and the performance, tried and tested performance, which we will continue in the next few years as well.
So you also, to get a great deal for your shareholders, you need to make sure your trading or your stock is trading at a attractive multiple to assets or even to profits, right? And it looks like your focus then over the next 2 years is defined. You need to get the bank to be a high performing bank, high multiple bank.
Absolutely.
Right. When you talk about consolidation, I mean, is it an option that a commercial bank can combine or merge with, for instance, a strong finance company, what you call a non-bank financial institution? Does that make sense?
It hasn't happened according to what I recollect in Sri Lanka before, but it definitely makes sense. I don't see any reason why not. So there would be some technological adjustments that need to be made. Obviously, there will be some cultural differences, but these can be overcome. And at the end of the day, what matters is ultimately the two organizations coming together like a marriage and bringing out the best of both and working together. So it doesn't have to sort of morph into one organization. They could still be part of one group and then bring out the best of each other, and there can be some rationalization in the management. So
and in the core systems.
In the core systems.
Right.
So
anything you want to add to conclude this conversation, Dilshan?
No, just to say that, it's a very interesting period for us. As a country, I think everything is very positive after a long time. We've had... This probably will be the third year where the current account is going to be a surplus. Fiscal deficit is at record lows. Remittance incomes at record highs. Tourism income is really good. And there is now a really strong positive momentum. And last week we saw the Cricket World Cup here. It was difficult to even get a room or even go into a restaurant in a hotel in Colombo. Right? So things are looking good. Of course, there is a cloud hanging over what's the most recent developments with the Iran-Israel conflict. But that aside, I think we have a very good opportunity now to really capitalize as a country. And, it's a good opportunity for our entrepreneurs to really, drive the production economy, import substitution, assembly, manufacturing, and, focus on exports. And really start investing in the infrastructure in the country. Even the condominiums around the country are almost filling up, right? So a lot of construction industry developments are also taking place. So it's a good time actually for the country after a lot of difficult times which we went through, very painful times. Now we have seen almost the third year now where the country has now got into the right kind of trajectory. And I think the banking sector played a huge role in that. The governor of the central bank, led by the governor of the central bank, taking some tough decisions at the beginning. And now I think this is a time for us to really, as a country, capitalize on the opportunities. Even with the current situation, there are opportunities that will come in. Because there will be certain countries, immediate example would be on the tourism front. Right? Many people who are now traveling to the Middle East or to the European countries, we have no little option but now to come to Asia. So that's another area that we can actually capitalize on. So it's important at this point that we are agile as a country to focus on what the opportunities are. And ultimately, when the country benefits and the business benefits, banks benefit as well.
Dilshan Rodrigo, always a delight to have a conversation. Thank you.